Hi there, it's me, Stephen Thomas, with Reports on Housing, and I'm coming to you with another housing debrief. But first, I wanted to talk about where we are as far as the housing market is concerned. We're first full week of August. A lot of the inventories are approaching the peak. Very few have actually reached the peak, but peaks occur in inventory normal markets between July and September. And it looks like it's going to be a normal peak this year. And that is because the second half of this year, we are actually going to have interest rates that are lower than the first half. Last couple of years, we actually had interest rates that were higher the second half compared to the first half. So the peak came later. So the peak, we're slowly but surely reaching those peaks, so there's not a lot of change in the inventory from week to week. Yeah, it's going up, but it's going up at a really slow rate right now. Demand actually had a bit of a spike, and that spike had everything to do with interest rates coming down so considerably over the course of the last few weeks. So if you have inventory levels that are going up and demand that's remaining relatively flat, just going up slightly, what's happening in the market is it's actually getting hotter. So as the interest rates continue to ease later on this year, you can imagine that demand is going to heat up and the inventory levels especially after it peaks out, are going to be continuing to go down. So the market is going to get hotter as the year progresses. Not typical for the second half of the year, but that's what happens when you have better rates in the second half of the year compared to the first half of the year. So, but let's get into today's topic, and waiting for the Fed to cut rates is wrong. Just don't wait for them to cut rates, and we'll explain why. Now, this is the federal funds rate. The federal funds rate has remained at the same level since July of last year. So pretty much it's been at the same level. They have not made any changes. That was the last time they increased rates, and they increased them by 1/4 point. Now, this is the federal funds short-term rate. Now, what's really tied to these, where interest rates can move really quickly, are automobile loans, credit card interest rates, as well as equity line of credit. That's tied to this federal funds rate, and when that goes down, those all go down. When the federal funds rate goes up, they go instantaneously up. Now, what has happened to interest rates since July of last year? In the last, it's been now 13 months. What's happened to interest rates when the federal funds rate has remained the same? And this is where interest rates have been. You could see that interest rates have floated all over the place. They have been 7%, all the way up to 8%, all the way back down. They've been kind of all over the place. It's an up and down roller coaster. And the reason for that is because the investors are trying to prognosticate. They're trying to forecast where's the Federal Reserve going to be with short-term rates future down the road. What are they going to have to do? Are they too high with rates? Is it too restrictive? Or are they going to have to increase more? This is what they're constantly looking at. Or are they going to maintain for longer? So it's kind of built into where rates are at today. So they're trying to figure out where the Federal Reserve is going to be with federal funds rate, and that's kind of how the markets move. And so that's one of the ways that the market moves. Another thing that happens is when there's really negative news, there tends to be an overreaction. When there's really, really positive news, there tends to be an overreaction. It's so a lot of times investors go out there and they buy too much, and a lot of times they sell too much. And then after that initial buying too much or selling too much, it changes after that. They recalibrate. And so this is where interest rates have been. They remained above 7% from the end of July of last year until the middle of December, when the Fed met and made an announcement. And so basically we hit 8% all the way in October. And I'm sorry these slides are so glitchy. Something's going on with the program that we utilize to put this thing together. But nonetheless, we are crushing it. We're going to roll right through this. Now, we reached 8% mortgage rates in October of last year. And that is what all the investors were trying to interpret what the Federal Reserve was saying. They were basically saying that they're going to continue to administer pain and we're going to continue higher for longer. And so all the investors out there believed them and said, you're not cutting rates anytime soon. So they sold all their bond issuances and they weren't buying mortgage-backed securities. And what happened to rates? Rates shot up all the way to 8%. Federal Reserve actually didn't like this, and immediately they started talking it down, and they said, there could be rate cuts down the road. And then along came December, and in December, the Fed orchestrated the fact that they're going to do 3 rate cuts, most likely in 2024. And as a result, we saw interest rates that came all the way down to 6.62%. And if you looked back, we were at 8% in October, made our way all the way down to 6.62% by the middle of December. That was such a gigantic swing in such a short period of time. But knowing that 6.62% when we reached it was most likely going to be a low that we were going to bounce off of, because typically you overbuy. And this is when they overbuy mortgage-backed securities and government bonds that we see rates come down this swiftly. So what's happened since then, since that point on in December, slowly but surely, we knew it was an overreaction by looking at all the numbers. The data looked really good for the last couple months of 2023, but in 2024, the data started looking a little bit too strong, that we really hadn't, it might have been getting better at the end of 2023, but still looked like the economy was really a lot hotter than what everybody was leading it on to be for the first few months. And as a result, slowly but surely, you saw that rates went up higher and higher, thinking that the Federal Reserve is not going to be being able to do all the cutting of the rates that they talked about earlier in the year and also in December. So then we got to 7.5%. It hit 7.5% 3 times in April, and that's because it was reporting on March. March's numbers is where we had CPI. CPI actually went up from month to month. From February to March, it went up slightly, only really slightly, but nonetheless, even though it went up, people were starting to talk about stagflation and all these ridiculous things, which we knew was just a nuance, and this was a one-time little blip on the radar that it was going to be coming down after this. Especially after peeling back everything, looking at owner equivalent rent, we knew that the CPI report was probably a little bit bogus, and that things would change as the year continued to unfold. And so sure enough, that's kind of what was happening. But then they met in June. The Federal Reserve met in June, and they then recalibrated how many rate cuts they were going to do. And they were like split between 2 rate cuts and 1 rate cut, and then even some were saying 0, so it averaged out to 1. And then interest rates were right at about 7%. So that's where it was when they said 1 rate cut for the rest of the year. We were at 7% mortgage rates. Well, keep in mind, in October we were at 8, so this is 1% below that. So this is where it was at as of June, right after the Federal Reserve met. And then along came the Federal Reserve when they met last in July. The end of July, they said that there would be rate cuts, and they are now they were talking about there's going to be rate cuts. We're definitely most likely going to have them, and then it looked more and more like everybody's on the same page that it was going to happen in September. And so then jobs came out, and Job Friday was at the first week of August. I think we were at August 2nd. That was last Friday. On August 2nd, we created a little over 100,000 jobs, and it was supposed to be like 160,000 jobs. So it was way less than expectations. Some of it was blamed on hurricane, but that didn't account for all of it. And while this was way lower, it still was over 100,000 jobs that were created. So it's not like the economy is tanking, but unemployment did tick up even higher, and unemployment's been ticking up higher and higher and higher on a monthly basis as each month unfolds. And then the market started to orchestrate 5 rate cuts. Now, they're only meeting 3 more times for the rest of the year. So they're talking about a couple times where they go a 0.5%, and one time where they go 0.25%. So they went from saying there's going to be 1 all the way to where we're going to have 5. And that's why there was this big overreaction. We got all the way down to 6.34% at the start of this year. That was Jobs Friday. Monday, there was more of that kind of like understanding what was happening with Jobs Friday. And then the Japanese stock market dove as well. So the combination of the two, we had interest rates that were really low for a hot minute at 6.34%. And you could see what's happened since then. Of course, it's bounced and it's gone a lot higher. And we'll explain where we go from here. But first, I wanted to bring in our sponsor and wanted to thank our sponsor. And that is Mike Grembaugh from JMJ Financial. You can reach Mike at 714-794-7668. That's 714-794-7668. He's a mortgage advisor at the Thibodeau Morel Group with JMJ Financial. And they have this great program. It's called the Home Start program. And the Home Start program, actually, they have better than market interest rates. There's no need to be a first-time buyer. As little as 3% down is required, up to $4,500 in lender credit. It must be your primary residence, and it follows the county loan limits. So those are some of the different program highlights. Now, this program, the eligibility is based on census tract. So you need to reach out to Mike to find out if a home is eligible. But if the home is eligible, it gives up to a $4,500 credit plus waives any rate adders. That means that if you have a FICO score of 660, you get the same rate as though you had an 800. Someone buying a condo receives the same rate as purchasing a single family residence home. It's good for purchases or refinances, and you could do a cash out refinance with a low FICO on a condo and get a rate like they were a top tier borrower purchasing and single family residence home. So please contact Mike for more details on that program. It's absolutely fantastic. They're just trying to open up and broaden the number of people that can actually get out there and purchase. You can contact him at 714-794-7668. That's 714-794-7668. Contact Mike today. And Mike, appreciate your sponsorship of the program. So we're back to where we were talking 5 rate cuts when we got to Monday. And then since then, there's been a big bounce in where rates are going to go. And that's because there was an overreaction. You know, that same overreaction where you get that one little, you got a brand new car and you have that first scratch and you overreact and you think, oh my gosh, it's the end of the world. And now your car, you're driving around and it has 3,000 scratches. You really don't care as much. But that first scratch, boy, you overreact to the fact that you got a scratch. So that's the overreaction. Oftentimes, Wall Street gets overbought or oversold. And that's where you bounce. When things are overbought, which is what happened with mortgage-backed securities, then after that, people are going, the appetite wanes and you get mortgage-backed securities. The rates go up, and that's kind of what's happened within the last week. They start selling them off. So you get this big bounce, and that's the bounce that we saw this week. And it really came down quite a bit because we were at 7.5%. We got all the way down to 6.34%. That is a big change in such a short period of time. So mortgage rates, it's different than the short-term federal funds rate. Mortgage rates and mortgage-backed securities run completely differently than those federal funds rate. They kind of go with the appetite of what's going on in the economy. So the investor looks at both of those the same. So mortgage-backed securities and 10-year treasuries are the same. So they're looking at mortgage-backed securities. That's what mortgage interest rates are tied to, and treasury bonds. And they're looking at that with the long-term issuance treasury bonds like 10-year treasuries, the same. So what happens is traders in Wall Street, they're constantly looking at all the economic numbers because the Federal Reserve said they're very, very data dependent. And as a result, when the overall economy is too strong, interest rates rise. That's kind of what we saw last year as interest rates got all the way up to 8%. The year just got away from itself and it was just too hot. consumption was really high, and then we had GDP numbers that were high. And then when the economy starts to show some cracks and where it's slowing down, kind of what's happened recently and where we are at today, you see rates that drop. So that's where we are actually at today. Now, as far as where interest rates are at right now, presently, the cuts that are coming in September are already baked into where rates are at today. They're already there. So as far as those people that are waiting, saying, I'm going to wait for September when the Federal Reserve cuts rates, they're not talking 30-year mortgage rates. They're talking the federal funds rate, which is maintained and been the same. We already seen that interest rates have changed quite a bit from 7.5%, from 8 to 7.5%, and in 7.5% in April, all the way to 6.34% on Monday of this week. So big, giant volatile change that got really low. And that's kind of what's happened today. So when the Federal Reserve comes out, what's going to happen to rates on that day? And I can actually tell you when they do cut, what happens, and we've seen it in the past. You saw this in COVID. They actually cut rates quite rapidly. You could see where they cut rates. They cut them quite a bit by 0.5%, and then they cut them even further, and they brought them all the way down from 0 to 0.25%. And you could see that rates didn't really move that much when they did that. And matter of fact, even when they were increasing rates, and you could see that with the steps up, we saw rates that on the given day that they increased rates, we saw rates actually went down for the day because it was already baked into where rates were already at. When they know that the interest rates are, that the federal funds rate's already going to go, a lot of people have already put that into the system, and today's mortgage rates reflect what the Federal Reserve is most likely going to do. So, and you can see that right here. This is where rates are at right now today, and then this is where the federal funds rate is. Federal funds rate still hasn't changed, and rates have come down quite a bit. And so you're wondering, gosh, when should I purchase? And that's where a lot of buyers are starting to figure it out, that you purchase when you can, because what's going to happen down the road, and we've talked about it, what's going to happen is we're going to get rates that continue to go down a little bit lower as the economy cools. And we're already seeing this bump in demand. The demand bump is only going to get larger as rates come down even more, and inventory levels will come down. So we're going to have a supply issue. This is going to be very reminiscent of the second half of 2020, all of 2021, and the first half of 2022, when there wasn't enough supply and demand started to, and demand went through the roof. And that's a recipe for not a lot of properties to see, A, and B, for values to go up. So right now, we're not getting a lot of push on values. Values aren't going up. So if you're a buyer, inventories are higher than they were last year. Demand's about the same. It's a little bit higher within just the last week. This is a good time to get in when you can look around and take your time and actually be able to purchase something with a really low rate. And a lot of people, the reason why we even mentioned that the refinance rate is going bonanza right now, that's because we had some people that locked in at 7.5%, and then interest rates came down a full percentage point. And with them coming down a full percentage point to 6.5%, people were ready to refinance because it made a difference in their payment. Right now, it's like one of those things. The big rule that I've always had is if interest rates come down 1%, you better contact Mike and have him do your refinance, because that's where the market's at right now. So this is why waiting for September is not the right move, because you wait till September, they make their change and cut rates, and you wonder, why didn't long-term mortgage rates move? And that's because they're already baked into today's mortgage rates. You need to watch all the economic news to see when the market reacts and we get rates that come down substantially. When they come down, that's a really good time to lock, because a lot of times, like I said, it overreacts. But as far as knowing exactly when to lock, it's when it makes sense for you, because it's a gamble. Rates could have been even lower, but they didn't. Instead, they bounced and they went even higher. And you got to look at all the numbers. Today is Thursday, and it's August 8th. And we had initial unemployment claims come out, and they weren't as big as what they thought. So since it wasn't as big, you know what? all the traders looked at it and said, oh, well, maybe the job market isn't slowing down as much as we thought. And we had interest rates go up a little bit today. So that's kind of what you have to watch on a daily basis. So we're very, very data dependent right now until the Fed says otherwise, which I hope that is what they talk about come this August. So anyways, that's what's going on as far as mortgage rates is concerned, and why you need to ignore September and just go now, because it's already baked into today's rates. Go to reportsonhousing.com for more information. Our latest report that just came out along the coast, and all the other markets will get it next week, is called Go for Gold, Don't Wait. We just talked about why not to wait, and that we have more interesting statistics and charts for each specific county that we cover. And go for gold. Don't wait. And you can utilize the coupon for a free month if you're not a subscriber, and that coupon is GOLD. So I want to thank you so much for staying tuned in to another housing debrief. I do have somebody that was supposed to be with me today and talk, and I'm going to show you. Oh, there he is. Come on over here, mister. He was half asleep a half a second ago. I had to show you him. He's my producer. This guy is, I promised him he could get on here, but there he is. It is Ezekiel. Ezekiel, what's going on in your life right now? Is something fun coming up?
My show's coming up.
Oh.
From Willy Wonka.
Oh, Willy Wonka? You're going to do a show called Wonka? Mm-hmm. Wow, that's cool. And what's your part?
My part's the affable of police.
Police officer. He's a police officer. So he's going to be in a play tomorrow, and it's called Wonka. Thank you for joining us, Zeke. And thank you for joining us. I hope you have a fantastic finish to your weekend. We will see you on the other side.